Welcome to Lesson 5, Preparing the Statement of Cash Flows for Mike's Bike Business. As you can see on the screen, the original database for Mike included Mike starting his business by putting in $40,000 of business from his personal savings account to finance his business. He then borrowed some more money, so he now has cash of $250,000, both of which are classified as financing activities. After arranging all of his financing, Mike is able to incur startup costs, and his first startup cost was to invest in a building. His cash went down and his building went up. He then incurred two regular startup operating costs where he bought insurance for $2,400 and he also bought an advertisement in the newspaper. After that, he bought 10 bikes for $1,000 each, which, as you can see, is classified as an operating outflow. And then he sold the bikes for $3,000 each, and he generated that amount of cash. So Mike started with zero cash at the beginning of the month, and he ended up with $86,600 cash. The purpose of today's lesson is to prepare a third formal financial statement called the Statement of Cash Flows. Now, the Statement of Cash Flows, when it's prepared formally, always starts out with cash flow from operating activities. The second part of the statement is the cash flow from investing activities. And the third part of the statement is called the cash flow from financing activities, which is our third category. Since this is our first month of operation, our beginning cash is zero, meaning we want to get to our ending cash. So the cash flow statement, let's look to see how much cash was paid for insurance. So let's go back to our database, and we see that Mike bought an insurance policy right there for $2,400. How much did he pay for advertising? The advertisement is right there, which is his second operating activity. Inventory is his third operating activity. And he collected money when he sold those bikes, so his cash flow inflow from operations was $30,000. So the four cash flow from operating items can be seen in his database next to each cash flow change denoted operating. So next, the next part of the cash flow statement is cash flows from investing activities. Here, Mike bought a building this year. So his building was purchased for how much? $180,000 in cash. And the last cash flows were his financing activities. He put in, he put in $40,000 from his personal checking, and he also put in $210,000 when he got the loan from the bank. So as you can see here, cash flow from operations was $16,600. He spent $180,000 on investing activities, and he took in $250,000 from his financing. Therefore, his cash went up a total of $86,600. He started with zero, so his ending balance in cash is $86,600, which you see here in his database, and you can also see that in his balance sheet right there. In conclusion, the Statement of Cash Flows is the third formal financial statement. We have the balance sheet, the income statement, and now we have the Statement of Cash Flows. The cash flow statement is sorted into three main business activities. These cash changes are either operating activities, they are investing activities, or they are financing activities. Now, in the next lesson, we will show you that there's another way to show cash flow from operations. We know it's $16,600, but most companies prepare cash flow from operations by comparing their direct cash flow changes with the income statement. And in that case, they must reconcile net income to cash flow from operations. So in the next and last video in this series, we're going to do the Statement of Cash Flows using not what we call the direct method. And by the way, this is called here this method is not called the indirect method, it's the direct method. In the next video, we're going to calculate this number right here using what we call the indirect method. This concludes video number 5 preparing the statement of cash flows for Mike's Bikes using the direct method.